Hello. In today's class, we'll be discussing about the generally accepted accounting principles. So, what do we mean by the term generally accepted accounting principles? So, in order to maintain the uniformity and consistency in the accounting records, certain rules or principles have been developed which are generally accepted by the accounting professionals. The rules are called by different names. They can be called as principles, concepts, conventions, postulates, assumptions, and also sometimes as modified principles. So generally accepted accounting principles, or GAAP as we know them, refers to the rules or guidelines which have been adopted for recording and reporting of the business transactions in order to maintain the uniformity in the preparation and presentation of the financial statements of an organization. So general accepted accounting principles have been evolved over a long period of time, and it's based on the various past experiences, usage, or at times at customs also. Statements by individuals, professional bodies, regulations by governments, all of these frame the generally accepted accounting principles and are generally followed by all the accounting professionals. These principles of accounting are generally static in nature and they do not change usually, but they are constantly under the influence of the changes that are happening in the legal, social, economic environment, and are based on the user's need. The term concept here, when we talk about the generally accepted accounting principle, the concept refers to the necessary assumptions, the ideas, which are the core fundamental of the accounting practices. The term convention connotes the customs and the traditions which form as the guides and the guidelines while the accounting statements are being prepared. So that is what we understand by generally accepted accounting principles. So basically the idea is that whether it be an accounting professional for country A or country Y, at least there should be certain aspects of preparation and presentation which are similar so that it is easy for the reader or the user of the information to make a sense out of that information or the financial statement which has been given. That is why it is generally followed by all the accounting professionals so that there is consistency, conformity, and the general conventions are in place so that the ultimate users are at the benefiting end. We'll continue with understanding certain basic accounting concepts in today's class. So, the basic accounting concepts can be referred to as the fundamental ideas of basic assumptions underlying the theory and the practice of accounting, and becomes the broad working rules for all accounting activities. And generally they are developed and prepared by the accounting professionals. So, few of the accounting concepts that we're going to learn are business entity, money measurement, going concern, accounting period, cost concept, dual aspect or duality as we know, revenue recognition or revenue realization, the matching principle, the full disclosure norms, the consistency, conservatism or what we call as an accounting prudence, materiality, and objectivity. So, let us start discussing a bit about the basic accounting concept. To start with, let us discuss something about what we know as business entity concept. So, this business entity concept, what does it tell us? It tells us that it is based on a basic assumption that the business is a distinct and separate entity from its owners. That means that any transaction that the business owner is doing on its own account should not get reflected into the books of accounts of the business and vice versa. So whatever is happening on the business front need not be accounted into the books, the personal books of accounts of the business owner. The idea is that the business owner is generally parting from its savings and giving the business what is called as the capital. And it is business's obligation to actually run the business in such a fashion so that it is able to make profit and ultimately then return this profit back to the owner. Right? And similarly, the owner is not supposed to draw anything out of the business as personal drawings, because that whatever has been invested in the business is the business's property, and it need not be thought that this can be withdrawn by the owner on his whims and fancies. So when in business something is added to the capital, the obligation of the business increases towards the owner, and wherever from the capital the owner draws something out, from that amount, maybe rupees 100, the overall capital obligation or the obligation of the business towards the business owner is reduced by rupees 100. So business entity also means that the business can have a property, can own asset in its own name. It need not be the case that it has to be in the name of the owner itself, but the business has its own separate legal entity, and it can take, it can buy a property on its own name, it can make expenses on its own name, right? And these transactions specifically pertain to the business and not to the owner.